Hello, welcome everybody to the second lecture. How's everyone doing? Hello. Good. Good evening. Yeah, thanks for coming on time. So yeah, good. Surviving the second lecture. So hope you guys are doing well. Um, So just to let everyone know, you probably receive a notification. The GBA groups are out. So I really encourage you to have a look on our tutorial group. So it's posted on our tutorial group. And make sure you just kind of reach out to your group mates, especially for those who did not reach out to them prior. So just reach out to them, see how they are, and maybe you can even kickstart reading through what's the requirement for the GBA. Okay. And after last lecture, I did receive some feedback to go a bit slower in terms of our coverage. So I'll try my best to go slower during our discussion. But I think like what I mentioned the last lecture, certain parts that are more for you to read through, I'll try to go a bit faster, and we will try to really focus on more important components of the lecture. And so definitely, this module being like a level 2, level 3 slash kind of module, um, fortunately or unfortunately, you still need a bit of background. So as much as possible, I'll try to make it as easy as possible, especially for many who might not have taken, like a more basic, FIN 203 or have yet to taken such a module. Okay, so that's what I'll try to do, make it as easy as possible. Okay. All right. So last lecture we have talked about the qualitative aspect of writing a report on how we value equity, right? So we talked about quite a bit of frameworks and recall what I mentioned last week that at the end of the day, the purpose of this entire module is to give you tools in order to value a company. So last lecture, in the first lecture, we talked about all the qualitative aspect, which is actually extremely important, even though we only use one lecture, right? So in your report, generally the qualitative aspect in terms of like your industry analysis, your company financial statement analysis, this usually constitute a good, 35% of your total report grades, right? So it's important, even though it's only one lecture, this part should not, the first lecture should not be overlooked. It's important to incorporate the various frameworks. I think like what we discussed last week, you need not use all the frameworks. For example, you need not use pastel and sword together. You can choose either or maybe just choose one. Or if you want, you can do both because you feel that certain aspect of the framework doesn't cover maybe like more of a competitive landscape. So you might want to do the portals and so on, something like that, right? So you need not do everything, but you can choose, pick and choose, and at the end of the day, your analysis should be as robust as possible, right? And so after last lecture, I think some of you all did ask, okay, so like in terms of the standards of writing the qualitative aspect of a valuation, right? So what's the standard like? So I really encourage you to jump onto Canvas. So let me just pull up Canvas very quickly, just to show you that there are actually two cases. So there are two cases here. As you can see, 90 case and the Spindex case. So the Spindex case, this is a Singapore firm listed on the SGX. They do manufacturing of heavy machineries and items. So in this case, this will be a very good example in terms of what kind of level of analysis you should do in terms of qualitative aspect. So you will see, they explain to you that they use a SWOT analysis here, and then they give some comparative advantages, etc. So you can look at this case. So the case will not for these two cases, we'll not really go through during class. However, these are very useful for your GBA, as well as understanding the whole, or even the ECA eventually, right? So these are very good example cases for you to go through. For the 90 case, this will be relevant after today's lecture, right? So do not worry about 90 case yet. After today's lecture, you have enough knowledge to actually understand what's happening in the Nike case, and also really encourage you to have a look at it next week when we don't have lecture on that. Of course, feel free to drop me an email anytime, if you do have any questions. All right. So, like last week, we'll take 2 breaks as well. So we have one at every hour, so we can just take a short brief. Right? Okay, so for today's lecture, we are now going into the quantitative aspect of valuation, right? So this is where we'll cover your discounted cash flow model. Now, um, have have anyone heard of this term called discounted cash flow model before? Yes. Okay. Okay, that's good. So maybe some of you all had prior experience in other modules, or maybe even like let's say in your poly days. Yeah. Okay, so that's good, right? But something that's different about this module is that we're not just going to do a simple discounted cash flow model because it's a level 2, level 3 module. We're going to quite a lot of details in terms of what kind of cash flow are we looking at, right? Now, as the as the title mentioned, is an introduction. So what does this mean? So because you all know that there's a class test for unit 1 and unit 2, right? So this uh lecture 2 on introduction in valuation methods will cover all the valuation models, right? But as a brief only, right? Then in the next lecture, we're going to detail in terms of each model. So there's a lot of detail to go into. And so then we'll go into detail on the dividend discount model, and we'll go into detail in the RI or residual income model, right? So this lecture is just really an overview, but it's very important because as an overview, it means that you do need to really understand the model in order for you to answer questions in your class test. Okay. So as usual, I really encourage you to either unmute yourself if you feel that question is a bit difficult to type out, or you can just type it on the group chat and we'll try to answer them together. Okay. All right. Okay, so let's go to basics first, right? What's discounted cash flow? Good that that most of you have heard discounted cash flow. So the idea behind it is, let's put it in a simple sense, right? A security is an asset, right? So any kind of asset that can give you cash flows will have certain values. And therefore, if we discount these future cash flows to the present day, then we're able to determine what's the actual value of this asset. And someone say Bitcoin or maybe even Ethereum, right? So they do have some intrinsic value in them. And if we can discount certain cash flows to the present, then we can determine their value, right? So this is a basic understanding of what does this discounted cash flow mean. So we just want to determine the value of the asset now, and the asset can be a physical asset, it can be a security like what we're talking about in this module. Okay, and so what's important, of course, is to determine the discount factor. The first thing that's important is how do you determine what factor to discount it on? So this is an important component, right? So we need to estimate the discount rate for the valuation. Now, there are two broad discount rate that we'll use. We'll use the cost of equity, and this means that we are discounting this to the equity holders. So instead, we are determining the cash flow to the equity holders. So we use the cost of equity as the discount rate, or we can use the cost of capital. So capital, as anyone recall what does capital consist of? Equity share. Okay, what else? Equity debt. Yeah, I see debt there. That's right. all the providers of capital. So you're right as well. It incorporates everything, right? Debt equity, generally called debt equity, or even like preferred stocks or preferred shares, right? Which is like preferred equities. Those are also considered part of equity, but they're kind of slightly different as well, right? So you're right. So cost of capital includes debt plus equity, right? So it has an additional component of debt as compared to cost of equity, it's just cost of equity, right? And so when you use the cost of capital, it means that we want to determine the cash flow to all claim holders of the firm. And you're right, you mentioned weighted debt and equity. So we'll talk about that in a bit. That's right. Okay, so the first step, as we can see here, is determining what's the discount rate, right? Once we know what's the discount rate, then we look at, are we going to discount it on nominal terms or real terms, right? Nominal meaning just the actual rate, or real means that you need to consider inflation, right? So inflation has to be considered, and you use the Fisher equation to determine the real rate. Last but not least, you need to think about things like, oh, no, what? Maybe the discount rate will vary across time, right? Especially in such a volatile environment, maybe the last 2 years where there's an increase, there's a rate hike, and then now there's a cutting of rates progressively, right? So the rates are changing quite a bit. So because of that, we might need to vary the rates across the different valuation years that we're trying to value the firm. Okay, this is what I was trying to say here. Um, so once we determine, okay, let's say we determine that the rates are going to be flat, they're not going to change, and we determine that we want to value it to the equity holders. That's why we use the cost of equity. Then we need to start, estimating the cash flows, right? Determine what's the cash flows. And to determine the cash flows, we need to determine what's the growth factor here, which we'll talk about in a bit. And then after that, there must be a terminal value, right? We call it TV here, where the firm will reach a growth level that is constant, right? So there's a terminal value. And then from there, that's where we can discount everything back. The terminal value, the cash flow here, which is the cash flow, we discount the cash flow against the, let's say, cost of equity, COE. So discount, that's why I put a divide because it's divided all the way back to present time here. And that's where we can get our valuation. Okay, so this is just a quick overview of what we're planning to do, right? Okay, so just on an intuitive kind of level, there are a few things to consider when we are doing choosing the discount rate, right? First of all, the most basic is, okay, are we discounting it to the firm or the equity, right? That's why we have the cost of equity and cost of capital, which is for the firm, right? So determine what are we trying to do first. Once we determine that, which is number one here, then we determine what's the currency that we're going to use to discount it. And last but not least, we are determining, is it a nominal or is it a real rate, right? If it's a real, then we have to use the Fisher equation to convert the nominal to a rate. Any questions so far? Okay, no. All right. Okay. So now let's go to the basics of the cost of capital. So like what you have all mentioned earlier, the cost of capital includes the equity and the debt, right? So it's basically the meaning is the cost to the firm for capital funding, right? And when you talk about cost, you need to talk about return as well. So this is actually the minimum amount of return that the providers must receive, right? So if it's something is a cost to you, it means that in order to break even, you need to be able to uh, obtain that amount of return so that you can break even. So the cost of the firm for capital funding or is the return that providers require. Of course, the return will depend on the asset risk level. And so, in your opinion, do you think debt or equity is more risky? Which one should have higher return? Equity. Yeah, you're right. That's right. So no one said that, but you're right. So correct. So equity is higher risk. So you, as an equity holder, you should receive higher returns compared to your debt, right? So risk and returns are proportional. Yes, get earlier claim. Yeah, that's right. So you're totally right. So the main reason why the risk level for debt is lower because debt holders get the immediate claim, the equity holders you get the last, right? If there's no money left, to that you don't get any returns from your investments. Okay. The rest are not so important. So basically, this is your discount factor here. Okay. Now, for cost of equity, so for equity means that we're just looking at the returns for equity holder, right? And if you look at this equity holder itself, then we actually have three different methods to determine the cost of equity that we can use, right? And again, I want to highlight to you again, in a case study, in your final ECA or GBA, things are very broad, right? You can use method one, because there are three methods here, right? One, two, three. But the idea is that you really need to determine what is the best method for you, because what I'm trying to teach you here are various tools. You need not use all the methods, but sometimes people like to use a combination of two methods. Let's say method one, method two, you do an average of both. That's possible as well. Or you do method one, two, three, and then average the cost of equity, right? So again, there's a lot of flexibility in terms of what cost of equity you use. And you will see that um, in lecture one, we talk about how valuation is like an art, right? It's not only a science. Yes, it's mathematical, you need to calculate stuff, but it's an art because every equity analyst will have a different valuation of the same firm simply because, like what you can see here, we have three methods method one, method two, method three for just determining the cost of equity. And you'll see this for the cost of debt as well, right? And so different different equity analysts will have different methods, and hence there will be different valuation at the end of the day. Okay, so for first method, the bond yield plus equity premium method. So this is rather um, simple in the sense that we know equity has higher risk compared to bonds, right? So if we are able to determine the yield of a bond, and let's say we determine the yield of, let's say, a government bond at this level here, then we will, with the equity premium that we can determine, which is this gap here, because you know equity is more risky than the bonds. So if with this gap, this equity premium, then we're able to determine what is the cost of equity. You just take the returns on the bond plus the equity premium, and this combination would then give you the cost of equity. Okay, that's the first method. Mm, Relatively easy, just look at market data. Now, for method two, this is where we are going to touch back on probably what you have learned in FIN 203, if for those that have taken this course. And so this method is to determine the beta, right? Use the beta of the stock to determine the cost of equity. And what's beta means, right? Let's do a recap. Because of course, I understand some of you all might not have even taken FIN 203. So let's try to understand what's beta first. So beta of a beta mu, okay, not that, but beta of a stock basically measures the systematic risk of the stock, right? And it measures the overall risk of that stock when there is no unsystematic risk. So what does it mean? Okay, so systematic risk is risk that is intrinsic to the security or the stock. So it's intrinsic means that it cannot be diversified away. Now, in a well-diversified portfolio, all your unsystematic risk has all been diversified away, right? So this is what we covered in FIN 203. So it's just a recap. So that's why it's not placed here. But I'm just trying to explain in case those that they have not taken that module, right? So beta measures systematic risk, and so in a situation where we have a fully diversified portfolio as stated here, all our unsystematic risk is being diversified away. Meaning what? Meaning whatever that's left is your beta risk, which is your systematic risk of the asset, right? And so this beta simply measures what? It measures the volatility of the stock relative to a benchmark, or we call it the market benchmark, right? So beta is not, kind of like a Greek, like fancy Greek thing that just appear out of nowhere. It's actually, it has meaning, right? In S&P 500, so S&P 500 S&P 500 would generally have a beta of close to 1 or 1 because it represents the market beta, right? It refers to the market. So market beta is 1, means the average risk, right? So you have a fully diversified portfolio, your is average risk for your beta is 1. Now, if you have a stock that has beta more than 1, it means that this stock has more risk than the market, more risk than S&P 500. Okay, so it's more risky, so more systematic risk. In a situation where your beta is less than 1 now, it means that this stock has less risk than the S&P 500 or less risk than the market. And so at the end of the day, if you have a beta of 0, this means that there's no risk, right? And the few instruments that have no risk is like your T-bill, right? So your government bonds, they have no risk, or they're as if it's riskless. All right. So now these two beta is very important. You need to memorize this. Where the market beta is 1, this is important. This is something you need to know as a baseline, as well as for risk-free beta or government bonds, the beta is 0. Okay, so these are put 2 stars here. So please be very clear on the beta. That's a good uh, uh, observation. Chinese stocks have low beta, but they are correlated to S&P. So low beta doesn't mean that it will be uncorrelated. It can be correlated, just that maybe, let's say S&P fall by 10%, maybe the Chinese stock fall by 5%, right? So it's less risky in that sense. Okay, so in your valuation, right? When you do valuation, sometimes if you do not believe the beta value that you can find on Yahoo Finance, or of course, I encourage you to use more sophisticated market intelligence platform, such as those that you can access on your school library. So I really encourage you to use the S&P Capital IQ Pro. I think most of y'all should have access to that, or the other platform you should have kind of forget the name. Let me just check. Because I was checking whether we can have access to that. Refinitiv, right? Refinitiv, or they call it the LSEG workspace. So I really encourage you to look at these two workspace, either S&P Capital IQ, which is part of your subscription, your library database, or if not, Refinitiv, or they call it LSEG, which I believe all of you should have access to. right? And so this market intelligence platform provides you a lot of data, including the beta, right? However, most of the time, the beta has adjustments to it. And so maybe as an equity analyst, right, you want to go really deep and fundamental. You want to determine what is the beta. You want to actually calculate the beta, which in other semesters, some groups really did that as well. They want to calculate the beta. They do a regression, so they regress the stock returns. So they did a regression of the stock returns against the market returns. So they actually did this regression to determine the beta um, as shown here, right? You get a beta based on the slope as C. Okay, so by doing so, you can actually verify whether the beta's value in the platform that you use is correct or wrong. Okay, I do see a question. If we're assessing a multinational company, should we use weighted average beta that reflects different risks across the international market? That's a good question. So generally, if you use a market intelligence tool, they would consider that data in a sense of the different risk distributions in different markets, as well as if you are doing a big group, right? So for example, a capital group. So capital group is super big. They include things like renewables. They have real estate. So there are multiple segments as well. And so generally, those kind of data, if you use on a market intelligence tool, would have consider some weighted average, let's say whether is it on the returns or the income level, the weighted average of the sector data. So you're right. Usually they have some weighting that's been done. One more question, isn't the bottom up data more accurate? So bottom up meaning that you calculate beta yourself. Is that what you're trying to say? To calculate beta yourself? Yeah. So depends, right? Because nowadays, market intelligence tool, they're expert that actually do this very sophisticated regression to determine the beta. They incorporate a lot of other adjustments, etc. So with the data that they have, sometimes the data they calculate can be more accurate. But of course, there are certain biases that is incorporated to their data that they use for the calculations, right? So really at the end of the day, let's say, right, for your project, you know, to calculate the whole data, you feel that it's too tiresome, you don't have to do it, right? You feel that what you can pull up from, let's say, Refinitiv is good enough, then use Refinitiv, right? It's good enough, right? But let's take a step further. Eventually, let's say you land a job as an equity analyst. Then maybe you think about it. Oh, I remember that, my lecturer at SUSS, he mentioned like, oh, we can try to calculate data to justify our valuation. Then at that point of time, when you have money at stake, maybe you have to do the extra step in calculating data, right? It's up to you. Uh, yes. So, at the end of the day, right, um, whether is it in your group project or your final report, at the end of the day, so generally, right, it's not like a tip or anything, but generally how people read a valuation report is not, they don't read it in sections, right? Meaning that they don't just read the quantitative, okay, they read the qualitative, okay, and then they mark them separately. No, usually it's marked as a whole report per se. So let's say you do your quantitative very well, but your qualitative component does not support your quantitative component, then there is a disjoint, and so your report in general would not score well. So there must be a very, very tight argument in terms of, let's say, whether you want to try to push a buy or you're trying to say you should stop the stock, right? There must be a very tight argument all the way from your qualitative to quantitative. And let's say calculating the data supports your valuation even more. Then when you do this calculation of the beta, that's where you can get I won't say extra mark, but you can really push your report to like an A standard, right? So that's usually how this kind of reports being marked. It's not marked in like sections. It's really, yes, there are certain percentage given to like qualitative, maybe like 35%, but at the same time, it must support your entire flow of the report. Right. So, of course, I always like to be very transparent. At the end of the day, even in the like the for such modules, you probably know about this, whether is it in your other modules or even let's say in a poly or other financial education institution. You know that whenever it's a more like a report based, even the marking scheme, does not prescribe like, okay, students should do this. It's not really that. It's almost like how the description of how a report should be. Then you get certain marks. The description in like let's say A count A grade report, a description of the B count report, and then it's really up to discretion. So there's quite a bit of discretion required. But at the same time, it means that in your report, it has to be very tight. It has to make sense throughout, and shouldn't be like very disjointed. Okay, so hope I answered that question. Going on to method two. So we are still on method two. The risk premium, like what earlier we mentioned, is the risk that is above your risk-free rate, right? What's the additional premium for your equity? So this is typically given by what's your return, expected return minus your risk-free rate. So basically, your risk premium is caused by your beta because you are taking on more risk or more systematic risk, which is why there's a risk premium that's involved. And this can be actually defined in a relationship in this SML line or security market line. Again, I would like to highlight this is a repeat of those that have taken FIN 203. So this is a repeat again. And so there's quite a lot of information here, right? So let's try to dissect this. Anyone remember what's the equation of a straight line? That's right. Y equals to mx plus c. Uh, Perfect. That's right. So the thing is, we are trying to define a relationship that brings together the beta and your return, right? So now let's put the return on the asset or expected return on asset as the y-axis and your beta on the x-axis here. And remember I mentioned that there are two beta that's very important. What is it? What's the market beta? Market beta is equals to 1. And what is the beta of a T-bill? 0, right? That's right. So beta of a R, which is a risk-free is 0. So there are two key betas that's quite important. So once I have my X and Y axis, I can plot my market beta at 1 here, right? And this will give me market returns, right? Market beta of 1. Now, I know that the beta of risk-free here is 0. So this is 0, and this is my risk-free return, right? RF. What's the return on your risk-free rate? Return on your government bonds, let's just say. So given that I have 2 points, now I can use my um, gradient formula. So gradient formula is your y2 minus y1, right? So y2 minus y1 divided by x2. X2 is this, 1 minus x1 is 0, right? So this will give me expected return on the market minus the risk-free rate. So this is my gradient. Rise and run. Oh, this is a nice way to remember. Okay, so once we have this is my gradient M here. And so what I can do is now I have my C as well, my intersect, which is given by this risk-free rate. So basically I can rewrite this into a y equals mx plus c or equation of a straight line, which is given by this, right? So equation of straight line, which is y equals to the m. What's m? M is this, right? We just calculated m is this. X, what's x? X is your beta I plus c, which is RF, right? So we have now come up with an equation. Of course, what is more important is this application of this thing called CAP-M. So everyone heard of CAP-M before? CAP-M model, capital, oops, sorry, uh, capital asset pricing model. Yes, okay, yeah, CAP-M model. So we have now kind of derived the CAP-M model here, right? And the CAP-M model is used to determine the um, cost of equity. Right, so this is a bit of a repeat. Just want to highlight to you the slope of the SML line gives you the risk and reward ratio, which is what we have kind of determined earlier, the gradient. Um, the slope equals to the market risk premium. Since beta of the market is 1, since this one is 1, right? This one is equal to 1, so the slope equals to just this part here, right? Return of the expected return of the market minus the risk-free rate. So in a equilibrium situation, at equilibrium, all our securities basically must fall on the SML line. What does this mean? At equilibrium, when our portfolio is all fully diversified, we only have the beta risk. It means that, in fact, actually all our securities will fall on this line at different levels, but at different points of the line. Of course, this is not really true in real life because there are a lot of inefficiencies. Maybe our portfolio is not fully diversified, and that's why we might not, all our securities do not fall on SML line. Now, having understood this, we can now determine the CAP-M model. The CAP-M model gives you, gives you this, right? So to determine the expected return on a asset, this can be determined by first taking the expected return on the market minus the risk-free rate. You multiply by the beta of that asset, you plus any risk-free, plus the risk-free rate. And this gives you your expected return on the equity. Now, there's a very important part to take note of. So when you read the question, please be very careful what they're giving you. Are they giving you market risk premium? So market risk premium means that they already give you the value of the expected return on the market minus risk-free rate. So that's the market risk premium, right? So if they give you market risk premium, means they are giving you this chunk of things here. So I use a different color. They're giving you this thing. So you just take the value of the market risk premium multiplied by beta and plus your risk-free rate. Sometimes they might give you market return. So market return means your S&P return or your Straits Times Index return in the Singapore context. And in that sense, they are only giving you, I'm just giving you a different color, they are giving you this component here, right? This one. So if they're giving you this, then you need to less off your risk-free rate. So please read the question carefully. Are they giving you market returns or are they giving you market risk premium? Okay, so yeah, that's a good question. So method 2 is using the beta, right? You determine a beta and then you use this CAP-M model to determine what's the expected return based on the beta. Now, method 1 is really just looking at market information, what's your um, uh, um, risk premium, what is your risk-free rate they're getting, and then you just add them both up. Okay, let's clarify. Uh, okay. So going on to method 3, method 3 is using the dividend growth model approach. So recall, last lecture I mentioned that if you need a recap of like time value of money, there is a deck of slides in the lecture, in our lecture group, or not lecture group, our tutorial group. So and also as well as end of lecture 1, we did have a some recap slides as well. So hopefully if you required a bit of the recap, we have looked through that. But if you have not, don't worry, you can always do it at the end of this lecture as well. But what we're doing here is we're using the growing perpetuity formula, right? So recall that a growing perpetuity formula is given by the prime P naught, which is the growing perpetuity, is given by the cash flow at D1, D1 meaning in year one, so year one, divided by the return on equity minus the growth factor, right? Because it's growing perpetually, keep on growing. Okay, so if you do that, what you can do is you can shift the RE to one side such that what you can do is we can determine the RE based on if you have the cash flow at D1 divided by the price of the current asset plus the growth factor here. Now, what's important I'll highlight here is that it needs to be at D1. So where D1 equals to D naught plus G. So what does this mean? What's D1, D naught? Okay, so maybe some of you are like, oh, you don't really can't understand, right? The thing is, this is based on dividend. So D1 is the next period dividend. You are totally right. So read the question carefully. Let's say, right, if the question say the dividend now. So they use now. If they use the word now, it means that this is D naught. Yeah. Can tell you're listening. Yeah. Now, if they say next year, now then this is D1. So that's how you determine whether it's D1 or D naught. Okay, so it's important to read the question very carefully. Now, okay, so that's the three methods for cost of equity. Any questions at this point before we go to cost of debt? So I hope this is not new, right? This is not new, or is it new for any of you? This cost of equity, especially like M, I think it's not new, right? Okay, that's good. That's good. Okay, now, so this is a bit of a recap again. These are cost of debt. So the cost of debt, there are three methods again, right? Cost of debt. So first method is to compute the yield to maturity on existing debt. So the thing is, you look at existing debt profile of the company, right? And then you calculate what's the yield to maturity based on this debt. So nowadays, right, with like let's say Refinitiv, right? If you're using Refinitiv, which is very powerful in terms of doing valuation, sometimes they even tell you what's the yield to maturity of the whole profile of um the company. Okay. Okay. So there's a question here. Interest expense divided by net debt. Now, this is a very wrong way of calculating your yield to maturity. And so why? Because you're taking, remember, your existing debt, right, has many different profiles, right? It has many different maturity. So you need to be very careful when you do that. In a sense, just you're doing basically what you're doing is average, right? Your interest expense divided by net debt. So it's a very accounting method, which remember we are not in accounting now. We are doing valuation. So we need to use very more relevant information. So you'll see just in the next slide why the first method is not good. Okay. Go use market value. Yeah, okay, so what you're saying is right. So use the rate function Excel, use yeah, and we'll see how to use the rate function in just a bit, and then using your book value or use market value, which is better. Yeah, use book value if you don't have market value. But that the I'm just going to put a note there that I really like the comment of say interest expense divided by net debt. So a lot of sometimes I do see quite a bit people like to use this, but this is not the right method, especially in valuation. Okay. So method two, we compute the yield to maturity of the new debt. but you must add any kind of credit risk premium. Um, and then third method is using the current rate based on the bond rating, right? We'll see what does it mean. But what's important I want to highlight is that the cost of debt is not the coupon rate. So whenever we look at questions, right, sometimes they ask you calculate what's the cost of debt, and then they give you like coupon rate and all. So please just be very careful. Your cost of debt is your yield to maturity. Um, so companies using debt to reduce. Okay, so there is a kind of a tax shield benefit whenever we use debt, all right? Because there's some tax deductibility on the interest as well. So you benefit from some tax shield. Okay. So moving on. Okay, so so for those that I know in, let's say, you already have taken more advanced module on like I know some of you all have taken, your bond valuation kind of modules. You know that I hope you realize that the yield to maturity is what's the yield when you hold the bond to maturity, right? So it's most of the time when we hold bonds, we do not hold it to maturity, and therefore there is some sensitivity in terms of um your duration in terms of your convexity if you don't hold bonds to maturity, and that will affect your yield to maturity, right? Or your yield, not your yield to maturity. So yield to put, yield to the where you end your bond, right? So in case those of you who have taken more advanced module in terms of bond valuation, determining the various yield, feel free to use those concepts as well. Remember, this module is very flexible. You can pull in knowledge from your other modules. But for those that have not done more advanced level bond valuation or yield valuation, for that, you can use what we are teaching now. That's fine too. Then I just want to put it out there in case those that have taken the valuation modules, right? So in the most basic form, if you have existing debt, please, repeat again, do not use interest expense divided by net debt. Please use your rate function. So let's look at this example here. We do have a 15-year bond. Coupon rate is 12%. Coupon annual, semi-annual, this is important, semi-annual. Your current bond price is this, right? So please use your rate function. Again, I want to highlight to you, in case you are rusty on this, how do you even use this rate function? Really encourage you to look through the recap slides on time value of money. We have talked about, I have more slides to really go through step by step. But we have kind of assumed in this module that you kind of know how to do this. So use your rate function. Because it's semi-annual, we need to multiply our maturity 15 years to times 2. And then the coupon, we need to take coupon divided by 2 times 1,000, because we know our face value, so it's 1,000. The bond price now is a negative value. And maybe your professor have told you this, but how I like to think about this is if money is going out of my pocket, it's going to be a negative. If money is coming into my pocket, it's positive. So what does this mean? It means that if I'm going to buy the bond now, it's going to cost me $1,253.72, right? So money is going out of my pocket, which is why it's a negative here. At the end of the day, I know that after the full maturity of this bond, I'm going to receive 1,000, right? So that's why it's a positive to me. That's how I determine positive and negative, right? So in case you kind of forgotten, when I put positive, when I put negative, it's not random. It's really looking at how the money is going into your pocket or out of your pocket. Okay, so by doing this, you get the rate, but please do not forget to multiply by 2. So I'm going to put a star here. This is, a big kind of mistake here, because what you have calculated in terms of the rate is on semi-annual, but we need to determine the bond, on annual basis. So do not forget this, right? Okay, so that's method one, which is the basic one, existing debt. Because if it's existing, we already have the debt profile, we have the price, etc. Everything's there, right? But also, just want to highlight to you, debt can be a bit tricky, right? Because remember, when you issue a debt, your mature number of years to maturity decrease over time, right? So please be very careful because then your current bond price changes as well, right? It's no longer current rate. You need to determine what's the current bond price, and then we need to calculate a rate. So just be very careful because when you look at the debt profile of a large company, it can be a bit complicated. Okay, so I'm thinking you saying different maturity of the bonds, right? Okay, so that's a very good question. Yes, that's a very good question. So there's the Nike case. So the Nike case, I would say everyone of you should look at Nike case because it will tackle all the mistakes that people will have in terms of what should we do. Like five, some left 10 years. Yeah, that's right. So the Nike case actually goes through this. So which bond should you choose? Right. So at the end of the day, right, there's various methods. There are various methods to determining, okay, if there's one whole list of bond, which one should we choose? Some people would say, okay, there's no right or wrong. Some people will say, let's look at what's our investment horizon. Is it 10 years? Right? If it's a 10 years, then we should choose a bond that's 10 years. And then let's say if okay, you have choose a bond that's 10 years, but you have multiple 10 years bond with different, let's say yield to maturity. You have completed the yield to maturity. They're all different. Then maybe you do a weighted average or you do a maybe a simple average, right? There's so there are multiple ways. At the end of the day, right, there's no wrong or right way. It's really about how you justify it, right? That's why I keep on emphasizing the quantitative and qualitative must work together and to come out a very robust report. So, okay, maybe you say you have to you want to choose a 10-year bond. And then for whatever reason, you say you only want to choose one of that bond, right? Maybe the company got 5 10-year bonds with different yield to maturity, but you only choose that one. Then, of course, the question is why do you choose that? You have to justify it. Maybe for whatever reason, you say that that bond is being pushed out to the market at a point of time that you feel that the market is at equilibrium, right? Unlike a certain, whatever market condition, black swan market condition that has caused the market to be imbalanced thereafter, and that's why you want to choose the bond in the subsequent years to do an average. So, it's really about how you justify. Okay. Okay, so that's existing debt. So most of the time you use method one because that's kind of the easiest method into determining your cost of debt. If you can't use method one, remember method one is not interest expense divided by net debt. That you use that method is straight away wrong. If you use interest expense divided by net debt, that's wrong. Okay, that's not right way. Now, method one is about using the rate function in Excel. Now, if you want to use method two, which is more on the new debt, what you can do is also, let's say you try to determine a bond holder of similar kind of risk level. You look at the firm's rating, right? And then after that, we determine the cost of debt by first taking the risk-free rate plus any additional credit risk that is relating to bonds, right? Because the thing about debt is what's the biggest risk of a debt holder is a default. It's a default risk, right? Default risk, i.e., credit risk. So whenever there's a default happening, that's where you have a credit risk situation. And so your cost of debt is basically your risk-free plus your credit risk combined together. Great. Then the question is, how do you determine your credit risk? So credit risk really is dependent on things like your credit rating, which is given here, your credit rating, and how long is your debt? Is it a 5, 10-year kind of debt? That's where you can add on the cost of debt. I do see a question, a message directly. So in case you don't know, all the recordings of our lectures are being posted on our tutorial group. So, in case you miss out any part of the lecture, you can always go back, or if you need to refresh yourself, you can always re-watch the lectures. Right. Something just to take note, this law more market convention. Credit spread is determined based on the basis point or BP. So 100 basis point means 1%. Okay, so I see a question. If we say an Indian debt, would we then use the risk rate of duration equals to the company's average debt maturity at the credit risk for the credit period, and then at the country risk premium as well? Um, let's see, risk of equals to the company's average debt. Yes, so I'm seeing what you're trying to say, that you need to add in an additional country risk premium, right? Is that your question? That we need to add this because the Indian debt, that's why we need to consider country risk premium. Um, yes. So 10 year, yeah, you can use. So what I'm saying is, you're saying, okay, use the risk free, then plus the default risk plus country risk. So three components. Yes, you can do that. If I'm not wrong, um, there's the report that is published by Damodaran on country risk premium. So you can go to that. His research on country risk premium is published, and most practitioners use his country risk premium number for their valuation. So that is a good way to do it. Of course, generally, if you are looking at a Singapore company, our country risk is very low. So we tend to not even consider country risk. But in other markets, we have to consider them, country risk. Right. So method three, look at bond rating. So company have a, I mean, so let's say the company wants to issue a debt instrument in a bond. Typically, they want to get the bond rated by agencies. In doing so, they can kind of market the bond much easier. And so based on the market agencies, let's say this kind of rating, we can determine what is the cost of debt based on the rating of the bond. Okay, lower rating, of course, more high risk bond. Okay. Last but not least, before we go for a short break, we have talked about equity, we've talked about bond. Last but not least, the preferred stocks. So that's a third component of our cost of capital. So preferred stocks generally not so common in most Singapore companies, Singapore listed companies, not very common after that. US companies, you might see this. So preferred stocks basically gives you constant dividends for the rest of the period. And in doing so, we kind of determine what's the return on preferred stock using our perpetuity formula. So these are perpetuity formula here. So because generally preferred stocks, right? They are more like uh, they are combination of debt and equity in a sense. Because usually preferred stocks do not get voting rights, right? They don't have voting rights. So they are not really equity, not ordinary equity. But at the same time, you get constant dividends. And constant dividends is almost like interest payment, right? So it might tend to look more like a debt instrument because you're getting interest in the form of dividends. At the same time, you have no rights to the company in terms of voting, right? So you might see it as more like a debt instrument. Yeah, but then this also is like that's why it's a bit middle, right? But then in a liquidation situation, you being a preferred stock holder will not get your money first, right? Your debt holder will you get your money first. So it's a bit here and there. You really determine it's somewhere in between. Yeah. And remember whether it's secured or unsecured debt, if you are just uh, if you have debt, basically the the banks that loan you money will always get in a liquidation situation, whether it's secure or unsecured, the banks would still get the money first, right? As a lender, the lender would still get money first, whether it's secure or unsecured. Maybe it's secure means that they have some asset and then you can sell the asset and then they can get the money quicker. Or in an unsecured situation, then they have to liquidate the whole company, right? There's an extreme situation, they will liquidate the whole company, then they get the money back. But in whether it's secure or unsecured, um, the debt holder will still get the money first, then equity holders. Whether it's senior or not, then that's how. Remember, the thing about senior and junior is not about whether you get your money, but it's about who gets money first, right? Of course, you're a senior, you get the money as a debt holder, you get the first part of the liquidation pool, and then your junior, you get less. So for preferred stock, they are separate. They are separate. Okay. We'll see that in just a bit. Just hold, yeah. So I just want to quickly show because you were asking the question. So in our WACC is separate. So preferred stock is RP. RP is given here. Okay. So it's three components. In case there is no preferred stock in your question, just ignore this. Right. So it's three separate components. All right, so there's a simple question here. Um, we have this water industry incorporated currently. So this is a D not. I hope you can see selling the shares at this and pays dividends of this annually. The current so this P not sorry P not. Okay, pays dividends annually of $2.50. So you just take $2.50 divided by 36. To give your cost of capital for preferred stocks. Yeah. Okay, so before we go for a break, let's just cover the WACC. So having talked about cost of equity, cost of debt, and for small component, just cost of preferred stock, which is, as I say, not very common. So really need to look at the question whether there's preferred stock. But let's say there is, then we can now use the weighted average of the various components to determine your cost of capital. Okay, I want to highlight to you here in terms of the weight, generally the market convention is to use market value, but this is not the best way. The best is to use the target, right? Target value. Okay, target value. In the next slide is mentioned here, right? Use target weights, but if it's not possible, use market value. Generally, we use market value because target unless it's hard to tell, right? So let's say if you are an internal finance person in the company, then you know what's the kind of target capital structure of the company. You have a lot more insider information, and therefore you do the valuation internally for the company. Then you know the target, right? But if you are just external third party kind of equity analyst, most of the time you just use market value. I want to highlight again to you or just emphasize that market value is not equals to balance sheet figure. Okay, so market value is not equal to balance sheet. So please be very careful. Do not just say, oh, okay, so that's a good question. Will market value be provided? So in your own report, in let's say your final exam, your group report, that's why it's a group report, or that's why your final exam is not a sit down 3 hour paper, right? Because you need to use information from internet, you need to do your own research. So in that sense, you need to determine your market value yourself. Yeah. So hope you can see that market value is not a balance sheet figure. So if you the numbers from your financial statement, it's going to be very wrong. Okay, it's going to be very wrong, and you'll be marked down for it. Uh, corporate tax, so something to take a note. So corporate tax, so I really encourage you to look at the 90 case. So tax can be quite complex in the sense the Nike case can't elaborate a lot more on this tax situation. So generally, we use the in Singapore, it's quite simple. The tax rate for a company, I think it's 19% flat rate. But let's say you are valuing a 17%, 17, right? So if you are valuing a US firm prior to the flat rate that was introduced by Trump during his first presidency, it was a graduated tax rate, right? So prior to Trump's first presidency, it was graduated tax rate, meaning what? Meaning that the tax rate changes. So for this corporate tax rate, it becomes very complicated. So this is just for your own information because now it doesn't really apply, but just for your own information, in case you are valuing a European firm in the Euro market, let's say in London or in Paris, you need to be very careful because their system is a graduated tax. It's like our income tax where it increases as your bracket goes up, right? So because of that, the tax rate that you use on a corporate basis needs to be the incremental tax. So what is the next bracket of tax you pay? Okay, I'm going to repeat this again. In case you are valuing a firm in the European market where their system is a graduated tax, you need to consider the incremental tax rate that you're going to pay for the next bracket, right? Need a flat tax. But luckily, if you're valuing a Singapore firm and a US firm now, it's a flat tax rate. So maybe this before we do an example, this is a good time. Let's take a short, 7 minutes break. Let's come back, at 8:07. Um, and if there are any questions, feel free to use the time on your break to just put down in a group chat, and we'll come back and answer them. All right. All right. Welcome back. I think I saw some questions. How do you determine market value of self? Quite confused here. Okay, so for market value, so there's a question on how do you determine market value, right? So for market value, not so difficult. So first of all, again, the Nike case, I'm publicizing the Nike case. So really encourage you to look at Nike case. But the Nike case actually go into details how do you determine market value, right? And so it's not so difficult. So for example, stocks, right? Most of the time, the company you are asked to value is a listed company. So we need to take the current stock price the stock price, current stock price multiplied by the number of stocks. They get the market value of the stock. Now, for the market value of the debt, again, the Nike case did mention about this. Yeah, have a look at it. How do you take market value of debt? We can look at the market intelligence platform. And then I think somebody asked about what's the platform called. So the platform I believe that all of y'all should have because I was still checking the school is called I'm just going to type it out, SEG, or they call it Refinitiv, this one, or Refinitiv, right? Or some of y'all might have this thing called S&P Capital IQ. So these are a couple of, oops, I'm actually typing direct. Sorry, supposed to for everyone. Let me retype again. Refinitiv, of L. All right, so these are the few platforms. So Refinitiv and LSEG are the same thing. So they are just different names. And then S&P Capital IQ is a separate platform. I believe you all should have at least one of them. So they are very critical in terms of doing your reports simply because the data provided is more accurate compared to what you can get on a free like Yahoo Finance, right? So a lot of the data is more accurate. They give you the methodology behind how they calculate things like beta. And so I do see a question on, what's the preference? Do you prefer to use a regression beta or bottom-up beta? So really to you, I understand, I can tell that some of you already did the course on how we use unlevel beta and level the beta. So if you have done such a course and you know what's the level beta, unlevel beta, please use it. Of course, we don't expect everyone to know, but in case you have done the course, then use the unlevel beta and level it yourself, right? Based on the capital structure of your firm. All right. Okay, I hope I answer the questions. Okay, we do have a discussion question here. So let's just look at this. Let me see, which question should we go through? Okay, I want to go through the second one. So I leave you guys to look through this discussion question, but let's focus on this second exercise, WACC exercise. So we are given two information. We have the equity information here, and we have the debt information, right? So let's look at the equity. So it gives you number of shares in millions. They give you a current share price. So this will determine your market value, right? In case you are looking for market value. Of course, this is a question, but in your report, you have to find out this information yourself. Good thing that give you your beta, market risk premium, and risk-free rate. So with this one, you can use your CAPM, CAPM. With this data here, you can use your rate function in Excel equals to rate to determine your market value of that. Okay, question. What is the market? Sorry, you use the rate function to determine your cost of debt. Now I have a question here. What is the market value of debt in this question here? Yeah, you're right. So 110. So I hope you can see that current value, this is your market value of debt. So please be very careful not to use this one. This is your face value of debt. So it's not your market value of debt. So your market value of equity, this is your market value of equity. So market value of EQ, equity. Okay, so with that in mind, I want to highlight some a student of yours actually pointed there's a typo. So in case you downloaded the slides not this evening, meaning that you downloaded a while back, this will have shown 100, but it's actually 1000. Okay, that's a PMT. Okay, so first of all, we can use the CAP-M model that we have determined to calculate the return on equity, RE, or cost of equity. Now, we can determine the cost of debt using the rate formula in Excel. Please multiply by 2 to annualize it. We know that for that, we have a tax shield. So we need to determine the after-tax cost of debt. On the market value side of things, you can determine the market value of equity. Market value of debt is kind of determined in the question. Do you give it to us at 1100? We can determine the various weight, and then we determine the WACC here. Even though this question has full workout solutions, I really encourage you to just give it a try by yourself. Really type it into Excel, see whether you can actually get the answer in your rate function as well. Okay, so I encourage you to do that. Any questions? Okay. Okay. So having done WACC, we are now okay. What is the difference between rate and yield in Excel? Is there a yield function? Let me see. Just give me a moment. Let me just check what's the yield function because I've not used that. Okay, yeah, I'm looking at Excel now. I do see a yield function. Uh, I think you should be able to get the same yield to maturity. Okay, yeah. So I think you will get the same value because rate also gives you the yield to maturity. But I think I'm looking at the formulation of yield. There are a bit more stuff they have to put in terms of the yield formula. Settlement, maturity. So I'm looking at yield function, redemption frequency. So I think it's just a different way to put it. But if you use the rate function, it gives you the interest rate of the loan, APR. It's not really a coupon rate, I think, for the yield function and a rate function. It's not really a coupon rate. It's still also the yield to maturity. But yeah, maybe I can have a look at it. What's the difference between yield and rate function and which one should you use? Because I have not really used the yield function. Always use the rate function, regardless of calculating. Whether yield to maturity. You don't really calculate coupon rate because yeah, coupon rate is a separate thing. Yeah, I do see that the yield function in Excel has a bit more things that you have to put in the redemption and all those. So I think it's a bit more sophisticated in to the extent that you have put in more other details. Um, yeah. Okay, so good question. Let me just have a look at what's the U function about. Maybe in the next lecture we can have a I can let you know what is it about. Okay. But so far we have covered now all everything about just more the discount factor, right? Discount rate, and I hope we can appreciate how complex is it to just do the discount or just the discount rate, whether it's the cost of capital or is it cost of equity, and even the cost of capital, we talk about the tax thing. Remember the tax about the graduated tax, about what tax you should use, and then about the market value versus target weight of, let's say, for your cost of capital. So there are a lot of nuance and granularity just on the discount rate, right? Discount rate. So that's all that we have talked about so far. Now let's go finally into the valuation. So let's look at how do we value the firm. And again, I want to repeat that in case you feel that how come we are talking about so many valuation methods and it's just so like touch and go. So don't worry, because we're going to go a deep dive in the next few lectures into each of the valuation method. And the first valuation method now going to talk about is the valuation with dividends, right? So the dividend discount model. So basically, this method is probably the simplest method, uh, and we are just looking at the dividends of any firm that pays dividends. Okay, and if they have a constant, kind of consistent dividend policy, then from then we can kind of value a firm using how much dividends they are paying out. Generally, they are for more seasoned, mature companies. They are profitable and stable. Okay, for example, utilities company. So there are few methods of kind of distributing dividends. First of all, the dividends must be declared. Okay, then they'll be paid. If it's not declared, means that there's no payment to shareholders. So that there's a declaration process. In terms of how much dividend is being paid out, this is just some information for yourself. You can just look at it. It can be a constant amount, it can be a constant dollar, or it can be, anything that's being left back, right? What's the residual amount for the dividends, right? This is just some information. So I'll not go into too much detail. Now, okay, so for our overview for this lecture, what's most important whenever we look at each valuation method is this slide here. So each method will have something like this arrow thingy, and this is the most important part. Okay, what does this mean? So let's dissect all the information step by step. Okay, so first of all, how do we determine dividends that's being paid? We look at what's the net income multiplied by the payout ratio. So there'll be a payout ratio, and so based on payout ratio, we can determine what is the dividends that's being paid. This first way of determining dividends. Now, sometimes if you don't know what is the payout ratio, we can then look at the financial statement and look at this equation, right? So this is going back to your accounting, accounting 101, where what's ERE? So what ERE is ending retained earnings. So the ending retained earnings equals to the beginning retained earnings plus your net income, NI, net income, minus the dividends, right? So in a situation where you have all this information here, where this one can be gotten from your balance sheet, this one can be gotten from P&L statement, right? If you are given information on the retained earnings and the net income, means that you can actually determine the dividends here. Okay, why is this important? So, of course, if you are doing a valuation report, you can just look at how much dividends is being paid from the statement of equity, right? Your statement of equity will show you how much dividends being paid. Or sometimes even your P&L statement might show it, right? Now, why is this formula important? Is because you have a class test, right? Sometimes a class test, they give you very limited information. They give you retained earnings. They give you bottom line, right? They ask you, can you use the dividend discount model to value a firm? Then you're like, oh, wait, I only got retained earnings, I only have the net income. How do I determine dividends? So that's why you need to know this basic formula, which is not new. So I hope that all of you have seen this formula in your accounting 101, where your ending retained earning, whatever that is using retained, is equal to what is beginning and the retained earnings plus any income, net income, minus any dividends. Okay, so this formula is very important. So this is method 2 to determine your dividends amount. Now, having your dividends ready, how do we value a firm? So we know that dividends is given to who? Dividends given to one kind of holders, equity holders, shareholders, you're right. Which is why we're going to discount it on the cost of equity base, right? Cost of equity. Okay. And then after that, we need to determine the growth, right? Because remember, our dividends is going to grow every year like this, right? Keep on growing, keep on growing, keep on growing. So we need to determine the growth factor, which we will talk about in the next slide, how we determine a growth factor, which is equals to retention ratio times return on equity. Okay, in the next slide, we'll talk about in detail. But once you determine this growth factor G, we can use this growth factor to then forecast the terminal value, here, terminal value, TV, which is the value that is given based on the growing perpetuity. Meaning what? Meaning these dividends will keep on growing at this rate forever. And so we're going to use the growing perpetuity formula as given here to determine what is the present value of growing perpetuity. And then this growing perpetuity will have to be discounted back all the way to time zero, as well as any dividends that's been determined all to time zero here. And this is where we'll find out what is our value. Okay, so again, we're not going to all this detail now because we are going to cover it in the next lecture and go to deep dive on how to do it. We do the step by step. But the idea is that we have a terminal value, which is a growing perpetuity forever. We discount it all the way back to time zero, as well as all the dividends all back to time zero based on the cost of equity. Any questions on this? The whole overview of how we're going to determine the price, the value of the stock based on the dividends. No, okay. Okay, so recall I mentioned that how did they determine the growth factor? So growth factor is based on this concept of sustainable growth rate G. So let's think about it, right? Let's think about it in a simple sense and not go into the whole detail of what's retention ratio and all, right? So the simple sense, right? The layman terms is this. To determine the growth factor is basically what is the growth of the firm if the firm is not going to use debt or it's not going to use equity. It's just going to generate growth internally. Take this idea, right? Generating growth internally. And when we think about generating growth internally, then we think about it as, oh, what is the retention, right? How much we retain? And then what's the return on equity? Then how much money is going to be received by equity holder? So the amount that's being received by equity holder from the retained amount, that is your growth rate, which is why your growth rate equals to retention rate times return on equity. And how do you determine retention rate? Retention rate is 1 minus dividend payout ratio. Or retention rate, you can consider it as the amount retained divided by total net income. And payout ratio is the dividends divided by net income or dividends per share. PS is per share divided by earnings per share. Right? So why you have all this formula here? Again, because in your class test, in case they give you some retention, they give you dividends amount and net income, they ask you to calculate what is your sustainable growth rate. You need to know how to piece them together to determine your sustainable growth rate. As well as one more important thing, in case they give you the decomposition of your ROE or return on equity, you will need to know how to compose it. What does it mean? Decomposition, meaning they give you equity multiplier, they give you total asset turnover and net profit margin. You need to know that multiplying these three factors together will give you your ROE. So really, given that the first kind of assessment that you have is more like short questions, like as what they posted, right? Questions and all. Then the focus is of course not really valuing the firm because that is more of your GBA, you really do your market research and everything. But if it's a short answer question, these are the small things that you need to really be careful about. Okay, so if you notice here, the determinant of growth will be for your DDM, discounted cash flow model, and your free cash flow to equity. So this one you'll see in just a bit. Okay. So I do see a question. Equity multiplier equals to asset divided by equity. Uh, okay. So how do we do this? Total equity. Yes, that's right. Because yeah. So it's divided by total equity. So just be careful, not just equity, but total equity. Yeah. Average total. Yeah. That's okay too. Okay. Okay. So that's the first valuation method, right? DDM. Let me see. Cash flow is not impairing. Okay, so now let's go into the two more important valuation method. Okay, it's not the most important, but more important in the sense that usually we use this one. Either the cash flow to firm or cash flow to equity. Okay, so free cash flow to firm, FCFF and FCFE. And I understand, this might be new to most people. Like DEM, most of you have probably seen it, but this might be a bit new. Why? It's because most probably you have seen free cash flow model, but you have not seen the specificity to the free cash flow to firm or free cash flow to equity holder. Right? So this is where you see a slight difference. So for free cash flow to firm, so what does it mean? Free cash flow to firm, it means that you are taking the view from both the equity and debt holder perspective. And since we talked about the discount rate earlier, question, should we use the cost of equity or cost of capital for discounting this? Cost of capital, you're right, capital. Cost of capital, because capital is for the whole firm, right? So hope you can tell straight away it's cost of capital. You're right. So I see FCFF is capital, FCFE is equity. That's right. So as cash flow provide after providing additional investments that can be distributed to the providers of capital, which is the debt to equity, without hampering the operations of the business. Now, in terms of the FCFE, that's where we just want to look at the perspective of equity holders. And means that the cash flow after providing additional investment and all debt service payment that can be distributed to the shareholders. So this is only to the shareholders. And you need to consider all the debt service payments, right? And we'll see this in just a little bit, how this plays out. Okay, so let's look at FCFF first, which is to the firm. Again, like we talk about it, we use the cost of capital, WACC. We need the cash flow to firm, and then we do a summation, right? Of course, we discount them as well. So the expected cash flow is the residual cash flow after meeting all operating expense and taxes and funding capital requirements and working capital needs. And so the question is, how do you determine this cash flow? Okay, so The first way to determine this is using this EBIT formula, right? So your FCFF equals to your EBIT, 1 minus tax, minus capex, minus depreciation, minus change in working capital. Okay, so this one is just one formula. Do not worry, because we have a next slide here which goes to detail how do we determine the formula per se, right? So how do you determine the free cash flow? Okay, so let's hold that thought for a while before we go there. But again, like I say, this slide, right, with the arrow, that is the like summary slide, which is the important slide that you need to understand. So first, we determine the cash flow. This is step one. We have already determined that for FCFF, we need to use the WACC. Okay, so WACC, just recall all the stuff that we talk about WACC, cost of equity, the cost of debt, there are three methods each, and then the weights, right? Use market value or target weight if possible. What else? Now, this is important. Okay, this is important. This especially is important for, kind of like short answer questions. Sometimes they ask you this kind of thing where it's quite intuitive, but then sometimes when they ask you, you can be a bit shocked, like, oh, how do you answer this, right? So what am I trying to say? Now, the value of the firm, we know that firm equals to equity plus debt, right? So in a situation where you calculated the value of the firm, and you know the question has the value of the debt, especially because you use the value of the debt in your market weight, then from there you can actually determine the value of your equity. So you just take value of firm minus value of debt equals value of equity. And so this uses the basic form of the firm equals equity plus debt. So just put this like equation in your back of your mind, because I know it's very intuitive, but sometimes when a question poses this to you, you will not think about, oh, I just need to since I already determined the value of the firm, I just need to know the value of the debt, I minus it off, I get the value of equity. So sometimes you're like, oh, how do I determine the value of equity? Suddenly it's like out of nowhere, right? So just put this equation in the back of your mind. The growth rate G, not too difficult. We are just going to assume the sustainable growth rate. Last but not least, we are going to use the terminal value again of a growing perpetuity here. Details will be covered in I think the fourth lecture. And so we have the FCFF. So in terms of the cash flow, I want to highlight again this slide, right, is actually adopted for your FIN 203. So it's kind of a repeat, but I'm really happy to see because this slide is very important. So I want to go through in detail. So what is happening here? So you determine the cash flow to the firm. We need to first start with operating cash flow. And again, I want to like emphasize that in finance is very different from accounting. So it's not your operating cash flow on your cash flow statement in your accounting statements. These are different, right? Remember, finance, we are looking about cash flow that is actually generated from assets. It's not your cash flow statement is your differences in terms of balance sheet, how your balance sheet increase over the years, and then they derive the value of your cash flow statement in your financial statement, right? So I mean, those are accounting trained, you know about how you can derive your cash flow statement from your balance sheet. So it's not that, right? Our cash flow that I talk about is about cash that's generated from assets. And this sense, this is a finance sense, right? So when we look at the operating cash flow, this is basically cash flow from daily operations. There are three derivations. We start off with the highest level. The highest level is we start with your net income, right? So your net income, you add back any non-cash item because your depreciation is non-cash. So depreciation is expenses, you add it back, right? Because you don't want to consider it. It's not a cash item, right? So you add it back because we are in finance. We're not interested in the accounting concept of depreciation, because depreciation is based on the accounting concept of matching principle, right? You are trying to match the expenses incurred by using the equipment, but these are all fictitious number, not really fictitious, is accounting number, right? In the sense that, let's say you use your laptop, your depreciation is 50%, right? So after 2 years, your laptop is being fully depreciated. But does that really mean that your laptop has no money or no value? No, right? It's just accounting concept of depreciating the laptop. So in this same sense, depreciation becomes an accounting concept and it's not relating to finance. That's why we add it back, right? We are not going to consider depreciation. And then with the interest expense, we do have some tax benefit as well. So we add it back. And the reason why is because our interest is not relating operations, right? Interest is relating to our capital structure, right? So we cannot be penalizing that. You're right, totally right. So it's relating to capital structure. So we're going to add back interest expense because it's not relating to anything that's operating. From there, we can further go up the P&L. So we can use EBIT instead, all right? And we can use EBITDA instead, right? So we go up. So I'm not going to show you how you derive it. I think in our next lecture, we're going to show, or the lecture 4, we'll have a derivation to show, to prove to you that these three formulas are actually equivalent, but it will never be tested. They will not ask you to prove. But under the idea is that you can use EBIT or you can use EBITDA. The reason why in the fourth lecture we have the proof is because previously, some students will be a bit peculiar. It's like, how come your EBIT is just plus depreciation? Why EBITDA become plus depreciation times tax rate? So, then I actually need the proof to actually try to show that. But of course, the proof is not, will never be tested, right? Okay, so we'll leave it to that in the fourth lecture. But now moving on to our net capital spend. So net capital spend is how much is being spent in capex, right? I want to highlight to you, to do that, you can either use your ending net FA minus your beginning net FA. So what's happening here? So what's FA? FA is fixed asset. So let's say you have a value of fixed asset, 100, right? Ending. Beginning, you have 80. So in that sense, you have kind of bought $20 worth of fixed asset. But remember that during the year, from when you increase from 80 to 100, you actually had some depreciation, which is why you add back depreciation. Let's say your depreciation amount is 10. So that's why you need add 10 here. And your net capital spend or your capex is 30. Right? I want to highlight to you again what's important, because while this looks quite simple, once you look at your financial statements for your company that you're going to value, it can be very complex. And there's multiple ways of presenting a financial statement. So please read carefully. Are you looking at, is the presentation on net basis? So net is important. That's why I highlighted net, or on gross. Because sometimes balance sheet is based on gross. So let's say if it's on gross basis, you do not need to care about depreciation, because gross means that it's before your depreciation. And so what does it mean? It means that you just take your ending gross FA minus beginning gross FA, and that's all. Because in the first sense, you do not consider depreciation already. Any questions on this? Or do you need me to repeat this again? Because this is important. Okay, no questions. We're good. Okay. Anyone have any? So one person is no. I guess rest are also no. Should be okay. Okay. All right. Okay. So net and gross. Let's look at the financial statement carefully. See what they give you. Are it gross basis or net basis? Okay, once we consider your capex, then we look at change in net working capital. Okay, your change in net working capital, this one, let's try to understand what is net working capital. So net working capital is CA minus CL, current asset minus current liabilities, right? But what I'm interested in is not net working capital, is the change in net working capital. Meaning what? You take your ending net working capital minus your beginning net working capital to give you the change in net working capital. I want to put a star here, and we'll come back to this in just a bit, right? So this formula of net working capital, CA minus CL, is a very basic accounting formula. In finance, this formula gets a bit more dynamic, I would say. So we'll look at our last example in this lecture. We'll look at this question where it's more dynamic in the sense that you can do some just here and there. We can, let's say, remove cash, we remove short-term debt and these kind of things, right? So it becomes very dynamic. And that's fine because if what you have noticed so far is that in equity valuation, right, it's like right, everyone has a different interpretation of a painting or how a painting should be painted. And so it becomes a very dynamic process. And I want to highlight to you that there's actually no right or wrong. It's really about how you justify and eventually come up with your valuation. So we'll look at this idea. Let's put another star here that net working capital formula is a bit dynamic. It's not just CA minus CL. Okay? Even though maybe accounting prof will say it's CA minus CL, but in finance, it's a bit more dynamic. Okay, so once we have the three components, 1, 2, and 3, please, minus them, operating minus your NCS minus your change in net working capital to get your FCFF. Okay, so a quite a common mistake is that sometimes students just say, oh, operating cash flow equals to FCFF. So they don't even consider this, just say operating cash flow equals to FCFF. So that's wrong. You need to consider your NCS, your net capital spent, as well as your change in net working capital. Okay. Determinant of growth factor, again, is the same thing. We use the sustainable growth rate as given by reinvestment rate times your return on capital. Something to take note of is this return on capital. Do you notice what's the difference between our sustainable growth rate previously? Yeah, return on equity, you're right. That's right. So because we are now at the firm level, we need to use the return on capital. So it's ROC instead of your return on equity. All right. So just be very careful what to use. What's ROIC? Return on what's the I? Sorry. Invested capital. Yeah, more or less the same. Yeah. Okay. Okay. So for your so that's for FCFF. Okay, before we move on to FCFE, do you have any question for FCFF? No. Okay, we're good. Okay. Okay, so your for your FCFE, what's this? What's happening here? Okay, so FCFE, we're now looking at the equity holders only, right? As we talked about it earlier, we are interested in discounting it at the cost of equity level, not the cost of capital. Now, having only being an equity level, we now have to consider the debt ratio. And what's this debt ratio? How come this debt ratio come in? Because we are not so we are not so interested in the component of the cash flow that is relating to the debt holders, right? Because we are only at equity holder level. So that's why we have to do some adjustment to this debt ratio thing, right? So in the next slide, we'll go through a bit more details on this cash flow, but just know that there's some adjustment that's required now because um we are interested only in equity holders. Your growth now is a return on equity, that's still the same, fine, that's still fine. Your terminal value is still assuming a growing perpetuity, and then we discount it all the way back to year zero. That's still okay. 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 So this is just a more mathematical formula. We have the cash flows that we talk about, and then we discount it at the cost of equity, and then we discount it back. Just something to take note of, your DDM, your discounted cash flow, is kind of a specialized case of a equity valuation. It's basically the same thing, right? Your FCFE and DDM is kind of using your discounting impact on the cost of equity. Yeah, on the formula, okay, let's look at this. On the cash flow component of it, the FCFE, right? Okay, so let's look at the formula. So your FCFE is equals to your FCFF minus your interest adjusted for tax, okay, plus the borrowings. So what's happening here now? What does this mean? It means that for FCFE, you need to consider your cash flow that is being like adjusting your cash flow that finally your equity holder will receive, because you need to adjust it because now you only consider you're not interested only on your equity holder, so you need to adjust your debt related cash flows that will affect your cash flows to your equity holder only. And that's why you need to minus your interest expense and need to add in any net debt that's happening. And what's net debt? Your net debt is, your additional borrowings minus any repayments, or in terms of a balance sheet kind of detail, you just take the change in your short-term debt minus plus your change in long-term debt. So any changes, the changes give you a net debt. Now, if I'm going to expand out your FCFF and then take into consideration your minus interest expense, the resultant is this. Okay, if I'm going to use your net NI, your net income. So I'm just going to flip back a few slides to just show you how come your interest expense minus interest expense times 1 minus tax rate suddenly disappear. Okay, I'm just going to flip back just for you to appreciate this, right? Let's try to appreciate this because we have this as your SCFF, part of the SCFF, your OCF has a net interest expense here, interest expense times 1 minus tax rate, which now is being offset again by this one here. Oh, it's very bad, the color. It's being offset by this again, right? So net, what you left is this. And so remember, we mentioned that in your FCFF, right, we do not want to consider the interest expense. That's why we add it back. But then now in your FCFE, we're considering your interest expense again because we're now interested only in the cash flows that finally remains for your equity holder, which is where we minus the interest expense. Is this clear? Because so this concept is quite important. why we are doing certain adjustments again to the cash flows. So hopefully by understanding this, you're not memorizing all the formulas like this and just like that, right? But you can't understand the reason why we minus the interest expense for FCFE, then why we add for FCFF. So in for cases where you have a target debt ratio, we can use this particular FCFF formula, which use the one minus debt or the target debt ratio to determine the FCFE. So what is debt ratio? Debt ratio is total debt divided by total asset. So this total debt and total asset can be the targeted value, or in a sense, it can also use your balance sheet figure if you don't have a target value. Okay. So now the question is, given that you have this, you discount cash flow to equity, the question is now, remember, probably this is a broken record already, but remember I talked about this course being giving you tools, right? So the question is, okay, I have a company is listed, is distributing dividends. Now the question is, should I use the DDM or should I use the FCFE? So let's try to understand when should you use each. So if the firm, well, of course, for DDM, the firm must pay dividends, right? So if the firm is paying dividends, that's fine. We can use DDM. And the thing is, we need to see whether the dividends that's paid is close to the FCFE, right? So let's say for certain firms, maybe they're paying very little dividends because they're not matured yet. Then perhaps dividend is not DDM is not the right method. But sometimes for certain firms, especially FI or financial institutions, it might be hard to use FCFE. And because financial institutions usually pay high dividends, using DDM can be actually quite a great way to value the banks. And so we can use the FCFE. Sorry, the DDM instead of the FCFE. Now, in a situation where the firm is paying very high dividends or very low dividends, then we might want to use the FCFE because maybe this firm is not matured yet, right? So it's like it's still fluctuating a lot in terms of the dividends payment. So use FCFE if the firm does not pay dividends. Okay, so I do see a question. Maybe this was a direct message, but I think it's useful to share it. So if the will the question state the target ratio? So I believe you are talking about this target ratio here, right? Will I be given this target debt ratio? So let's say if it's a question in a sense of like the quiz that we have for lecture 1 and 2, these are short answer questions, right? They might be some MCQ short answer questions. So of course, whatever information is provided to you in the question, but on a more broader sense, right? Because this module is about valuing companies, equities. In most cases, if you're going to pull out market data, it's might be a bit tough to find what is the target debt ratio. Sometimes there is, I would say, especially if you use the market intelligence platform like Bloomberg, which of course is very comprehensive. Even Refinitiv is not too bad as well. Sometimes they might provide some target debt ratio, and these are ratios calculated by equity analysts by themselves, right? So it's not given by the companies. Like them analysts actually calculate these numbers. So sometimes you might be able to find that, and then you can use these values as well for your calculations. Okay, so maybe now is a good time. Let's take a break, another break. Like what I usually like to do, 2 breaks. So good time to kind of come back maybe within another like 7 minutes, 7 to 8 minutes, before we move on to reasons why we should use FCFF or FCFE. So this one is a bit more elaborated. All right. So let's come back in 7 minutes. And if you do have any questions again, put them in group chat. We'll come back and discuss them. Welcome to the last part of today's lecture. Okay, so just before you left off, we were talking about FCFF and FCFE. So the question is, when should you choose which valuation method, right? Of course, the most basic form is, what do you want to achieve, right? Are we taking both the perspective of equity and debt holder? And if yes, straight away we know we do the FCFF. And so we want to understand a little more, right? For the FCFF, if we look at the FCFF equation, what we have done is actually to add back interest expense, and we kind of talk about this a little bit earlier, right? And the idea is that the reason why you add it back is because you do not want to take into account debt, since you are taking into account both the debt equity and debt holders perspective in your FCFF. And I hope this makes sense, right? Because if we are taking both the perspective of debt and equity holder, then we shouldn't even consider the cash flow as being affected by the interest expense from the debt. Because the debt holder is getting the interest, right? So does that make sense to consider that in our FCFF cash flow? And that's why we add it back. Right? So we use the FCFF when we have, high leverage and expect a low leverage over time. And this is because if there's a change in the leverage, this will not affect the cash flow that's affected from the taking on leverage or deleveraging, because we are adding back the interest expense, right? So this is not being factored in. The interest expense cash flow is not factored in, and therefore the change in leverage does not really affect the firm, and so you can use the FCFF. Okay, so you can use it also for firms that have partial information on leverage, because again, we're not taking account leverage. In case that, of course, you are interested in valuing the firm, so that's very obvious. You are valuing a firm, we do FCFF. For firm with multiple divisions with different growth prospect, you can use the firm level as well, or if you only want to value one division. So there are just a few reasons why you use the FCFF. Now, going to the FCFE, so now we are taking on the perspective of just the equity holder, right? And so this means that we have to consider debt in our cash flow as an equity holder, and which is the reason why we need to minus the interest expense again from the FCFF formula to get the FCFE. And so when you minus it, you are again considering the interest expense, your FCFF, and then you add also the net debt, which is related to debt profile, right? Because now we are interested in the equity perspective, for the equity holder perspective. So in the FCFE, there's an alternative formula of using the targeted debt ratio. You notice that we did not add back the interest expense times 1 minus tax rate into this formula here, right? And so it means that considering debt in the equation, and the 1 minus debt ratio apportions the NCS and the net change in net working capital based on the amount that is relating to the equity holders, and that's why gives you the cash flow to the equity holders only. So we use the FCFE generally for firms that have more stable leverage, because we are considering that cash flow in our cash flow projections. Therefore, if there's a large change, we'll see if there's large change in leverage, then we'll see large changes in our cash flows that might not be growing at a sustainable growth rate. So In this sense, in other words, it means that we usually use this for firms with very clear capital structure, very stable capital structure. Maybe it can be a single division, and firms that, of course, not pay all the cash flow as dividends, so there's some free cash flow to the equity holders. Okay. All right. So has anyone heard about residual income model, or this is totally new? So these are our fourth model. So we talk about um FCFE, FCFF, BDM, and now our last model is residual income. Have you heard of this before? New? Yes, okay. Oh, so one is new, yes, first time. Okay, so maybe a mix for this. New, okay. Okay, so residual income. So let's try to think of it, in layman terms, in simple sense, right? So, okay, so we have heard residual income. So let's try to think of it in simple sense before we dive into all the details again, right? So residual income model, right? The idea is this. The idea is from an economic concept where we need to consider both implicit costs and explicit costs. Okay, so what's the difference? Explicit cost is cost that is seen in the balance sheet, is sorry, not balance sheet, in the P&L statement, right? Cost that is actually there. But there are implicit costs that are not there, right? And so yeah, in order to or in order to consider all costs, instead of using the financial statements, which only have explicit costs, let's use more of a economic concept of cost. How do you define cost? We just take the cost of equity, right? The cost of equity, which is a percentage, will have all the costs involved, right? You take the cost of equity, you maybe multiply it by the amount of equity that you have, it will give you the total cost of equity. Yeah, I repeat this again. If you have the cost of equity, which is a percentage, let's say cost of equity is 1%. If you have the equity amount, which is, let's say, 1 million, 1 million multiplied by the 1%, this gives you your total cost of the equity, right? 1% times 1 million. So if this concept, right, count will count both the explicit and implicit costs relating to the profit. And this is exactly what we're trying to do here in residual income. Because we are not going to rely simply on the balance sheet. We are going to use the concept of implicit and cost plus explicit cost in our determination of profit. Okay, so what I've explained to you will make sense. So, again, this is more just written down in a nice way. Accounting concept, accounting profit is simply the explicit cost. We use the economic profit model in the sense of both implicit and explicit minus all costs involved. Okay, so it's just what I can't already explain. If you understand that, then uh, yeah, it's just written down nicely. So residual income is not really a cash flow concept. It's actually just an increase in the shareholders' equity, right? Because you're looking at the cost of equity and then what's the current equity that the firm has. Okay, residual income is the net income less any cost relating to the cost of equity. So this is actually termed equity charge, right? So cost of equity is called equity charge. So the residual income model consists of two parts. First, we have the current value of your book value of equity. So you have a value here, right? Let's say X. You have this thing called X. Oh, sorry. Okay, let's rewrite this again. We have X. Then we need to plus all your present value of your residual income. So you add back all your present value it. These are all your cash flows to your this point here. And this value here plus your base value of current book value. That's how you determine the value of your equity using this residual income. So it's got two components. I repeat again. X, which is your book value of equity, plus your discounted cash flow of your RI, residual income, to year zero. Year zero. So 1 plus 2 gives you your valuation of your equity based on residual income model. I do see a question here. Profit attributable to company minus perpetual. No, this is not your residual income model. No, this is not. Your profit distributable to owner, okay, minus special capital security distribution. Yeah, this is not your residual income model. Okay, so let's try to understand what's the how. Okay, so like I mentioned earlier, there are two components, right? Uh, one and two, two components here. So let's look at component two first, right? So let's focus on component two here. So component two is how do you determine residual income? So residual income, like I mentioned, first there are two kind of residual income, right? They are kind of the same, just residual income and residual income per share. So just so it's one per share, one no per share, right? So the formulation is kind of the same. So let's look at residual income first. So residual income equals to your net income minus your equity charge. Okay, so what's equity charge? Remember equity charge I mentioned earlier? Equity charge is basically just your book value of equity. What is your value of equity times the cost of equity, right? Cost of equity times your amount of equity gives you the implicit and explicit cost relating to your equity. By doing so, you can get your residual income. So this is the first formulation. Or the second formulation, we can do some algebra manipulation and we can give it to ROE minus cost of equity will give you your book value of equity. So the question is, oh, how come suddenly become ROE? So what's ROE? So return on equity is net income divided by equity as E minus the cost of equity, right? Times your equity, right? Book value of equity is equity. So remember when we multiply in like this, what does it equate? It's net income minus cost of equity times E, right? So can you see that formulation 2 given by this is the same as actually formulation 1. They're the same thing. There are some small little highlights here to highlight to you that please make sure you use the right period when determining the equity. So your net income will be in the first your current period. Your equity is always one period behind. That's because the cost is relating to the equity that is one period behind, right? That will give you your current period's net profit. That's why the book value equity is always T minus 1. So in case you're given the per share method, the per share uh, is the same thing. The names are different. It's not net income. They'll tell you earnings per share, right? Per share. So just everything is per share. So just read the question carefully. What are they giving you? Whether it's per share basis or just a residual income. Uh, that is not per share. It's just residual income. Yes, so you can use either this one or this one. Is the same. Uh, but the thing is, the main difference is this is residual income per share. So if it's a per share basis, let's say you are valuing a firm, right? Then you need to multiply it by the number of share to get what's the actual residual income. So why I put two formulation here? Because sometimes for your own self, when you determine when you do your valuation report, of course you can use whatever that is most convenient. But sometimes, let's say in a quiz or short answer question, right? Sometimes they give you EPS. Then it's like, oh, EPS, if let's say if I do not talk about this at all, right? It's like, oh, what's EPS? If you do not connect the dot that EPS is actually just net income per share or earnings per share, it's the same as net income per share, then you will like, oh, you know how to do it, right? So that's why I kind of like, tell you that, hey, actually, you know what? If you have a example that gives you earnings per share, it's actually the same thing as just net income divided by number of shares, and you just need to multiply by a total number of shares eventually to get your residual income. Yeah. Okay, so why using T minus 1 again? So why use T minus 1 is because your cost relates to the cost that's incurred in the current period, but based on the book value of the equity in the last period, right? So for example, your earnings now is based on what's the cost incurred by the equity of the last period. Because remember, during the year, let's say um current year, let's not use current. Okay, so 2024, let's say 2024, okay, so you want to determine the residual income of 2025, right? But then the residual income of 2025, yes, you have the net income of 2025. But the thing is, between 2024 to 2025, maybe there's some changes in the equity book value. But the cost that is relating to this, the generation of your income for 2025 is based on 2024's book value of equity. Okay, I repeat this again. Let's say you are determining the residual income of 2025, right? Now, between 2024 and 2025, there might be some changes in your equity value, your book value of equity. But in essence, the cost relating to your generation of your net income for 2025 is relating to your 2024's book value of equity, which is why we use book value of equity T minus 1. Okay, and then maybe the question is, what is book value of equity? Book value of equity generally refers to any payout capital plus your retained earnings. Clarifies. Okay, so now we can quite easily see the two parts that's happening here. The two parts being the one, where is your book value of equity, plus any of your residual income that's happening, right? So this combination of this plus this gives you your valuation of your security using your residual income model. Okay, you might see why this equals to this. This is basically the same formulation. So I'm just going to flip back to the slide here. So remember, I talked about this as formulation 1 and formulation 2. So it's just the same thing, right? Formulation 1, formulation 2. So I hope, let me just repeat this one more time. The residual income valuation model consists of two parts, your book value of equity and your residual income, your present value of all your residual income. So it's two parts. So residual income is only on the second part, right? That's where it comes in. Payout capital basically is how much is being invested by the shareholders at the start. So in your financial statement, you see that there's the payout capital, which means like, let's say is 1 million is being invested by 3 investors, then that's called your payout capital, or it's being paid. Sometimes nowadays there's different terms. It might not be called payout capital. It can become ordinary shares or something like that. Ordinary shares. That is payout capital. Something to just take note of. Again, we are at the level of equity So we are going to discount it at the return on equity. Yeah, return on equity. Okay, so this component, right, is very important in the sense of really understanding residual income. So I'm just going to put a two-star here. So please, if you do have questions, raise them in the group chat or you can unmute yourself. But let me try and explain to you in simple terms what is happening here, right? Before we look at this whole chunk of words. Okay, so this will be tapping on your accounting module, and most of you all being, year three. Hopefully, this is not new or you have heard about this in the accounting modules before. So the idea of this, right, is that this residual income model strongly depend on this concept of clean surplus relationship. So the question is, what on earth is this clean surplus relationship and why these funny things are come about, right? So let's go back to accounting, right? So the thing is, in accounting, when we have our book value of equity, this clean surplus relationship means that there shouldn't be any kind of capital injection, stock option, buyback, which will impact your book value of equity in between the times that you are determining your residual income model. In other words, what does it mean? It means, let me just flip back, your book value of equity only purely is determined by your payout capital and your retained earnings. There is no like, share buybacks. There's no this type of share buybacks, buyback, or other things that will affect your book value of equity. It's only determined by A and B here. Payout capital plus retained earnings. Okay? And number two, it does not include things that impact the things that are your OCI. So what's OCI? So this will tap back on your accounting module where it does not take into account things like your other comprehensive income items. And so what's interesting, because your other comprehensive income items in OCI impacts your retained earnings directly and does not impact your net income. So this is a bit technical. Why? Because remember, your OCI items are below your bottom line, right? Bottom line is your net income, and your OCI is after bottom line. What does this mean? It means that these items below the bottom line is not reflected in your net income, right? Your gain, let's say your gain and loss of translation, is not going to impact your bottom line, which is your net profit, but then it's going to impact directly your retained earnings. So it's a very technical point where if you are accounting major, which I know some of you are, you will know that this it's a very interesting concept where your losses, which is like your expenses, or your gains, which is like your income, is not going to impact your bottom line, which most people look at, your net income, right? Your net profit is not going to impact that, but it's going to still translate to your losses or gains in your retained earnings, which will translate to losses or gains in your equity. So this is a very peculiar situation. And so these items are not considered when we are talking about the clean surplus relationship here. Okay? So having understood this, we are now in a situation of clean surplus, meaning what? Your book value of equity is equal to just pay up capital plus your retained earnings, right? And in this sense, based on the clean surplus relationship, your current book value of your equity is simply your previous book value of equity, previous book value of equity, plus any retained earnings that you have retained. Because we're not because there is no capital injection, there's no stock options, and there's no OCI stuff that's happening, right? So it's just what's your current book value is just your past book value plus retained earnings, which is given by these simple sets. And then the question is, what is retained earnings, right? What's retained earnings? Retained earnings is basically your net income minus away any dividend that you have been paid, right? So what retained is whatever earnings that you are retaining in the business. So it's your net income minus away your dividends. And so if we substitute retained earnings equals to net income minus dividends into this retained earnings here, now our value of equity equals to previous book value of equity plus net income minus dividends, as given in this formula here. So then now you're asking, wow, how come go in such detail about the clean surplus? And then now we talk about this formula. So hold to that thought, because the next slide will now bring everything into context for you. So why do you even talk about all those details, right? All those details just to actually emphasize one point, that the residual income model is conceptually sound to the DCF, discounted cash flow. In fact, it's actually very similar to your DDM, which is why we can use the cost of equity discount this residual income. And so let's further prove this, right? So we know that the DDM is like this, so very easy dividends divided by your various discounted by your various cost of equity. Earlier, we already proved the clean surplus relationship. We can determine this, right? I'm just going to flip back to highlight to you where we have determined this. It's given here. So I'm just going to do some algebra to make dividend the subject, right? So dividend equals to book value minus 1, minus the book value now, plus the net income now. So given that you are at a dividend level, we can substitute this chunk of thing into here, right? Substitute here like this. And so by substituting there, and we just do a bit of shifting or manipulation, what we can get is actually just putting we combine all the book value B naught together, and then we can actually get a formulation like this, which in other words means your book value now plus all your summation of your various income that you have made minus the equity charge. So the whole conversation about the clean surplus relationship basically is just trying to show you that, hey, you know what? This residual income model, even though it's based on accounting concept of profit, we are using the implicit kind of cost. But at the end of the day, it's still relating to the DCF model, particularly the DDM, and we can prove it by assuming, of course, a few difficult assumptions like the clean surplus relationship. Okay, so there are just some pointers to let us elaborate a little more. So for each model, we can derive the underlying theoretical model. Let's see. Okay, this is important part. Okay, that's why I go here. The residual income model starts with a different base, because the residual income model starts with B naught, right? So B naught given here, whereas B naught here, right? So it starts with the B naught, which is based on the balance sheet number, and you add in the various residual income to determine your final value of your company. So this is very different from your rest of the model, where if you notice, right, let me just flip back quickly for you to have a look. If you notice that the previous models we always talk about this thing called the terminal value, which we have to determine. And this terminal value is determined by largely, you will notice the growth rate, how you're going to predict the growth, which is then this is usually the larger chunk of the value, right? The terminal value. So the residual income model flips the valuation in terms of having the initial value based on the, or the larger portion of the initial value based on the balance sheet figure, which is the book value of the equity at B now. So we use the residual income model, in terms of if we don't know what's the terminal value, is very uncertain, maybe there's negative free cash flow, we use residual income. We can use residual income also for checking out consistency. And this one we'll talk about, and we use the cost of equity or residual income. Okay. So this is an extremely good summary slide of what we have talked about. We have 4 different models, DDM, 1, 2, 3, and 4. So again, I'd like to repeat, yes, there's quite a bit of information for this module, or especially this lecture, but remember that for the next 2 lectures at least, we're going to go into a lot of detail in each model, 1, 2, 3, and 4. And we'll see a lot more deeper understanding on how we use the model, when we'll have multiple examples. If you notice that we have not really go through deep examples, so do not worry, we'll go through them in the next 2 lectures. Okay, there is one last example I'd like to go through before we end today's lecture. And so this is a good, more of a broad-based kind of example. Okay, so let's look at here. So we are given this income statement and balance sheet. Of course, it's a bit simple. Some important things to take note, I just want to highlight to you. We are given gross fixed income. There's also accumulated depreciation and net fixed income. Recall that when we talk about our FCFF, our NCS component, NCS, I did mention about being very careful about net and gross, so be careful about this. Where else are we interested to look at? Let's see. In this sense, we have our payout capital and our net income here. Potentially, this means that we can do our residual income model, RI. In terms of our current assets, what do we have? Our current assets is given by this chunk of thing, right? Our current liabilities is given by what? Our current liability is given by this chunk of things here, right? We have some debt here, long-term debt here. Just some important things to look at. Now, the question is, so there's this company called Rainbow Magnet that has a dividend policy of 60% of its earning as dividends. The company plans to undertake an expansion of its business, estimates that it needs 5 million additional investment in fixed assets. Okay, working capital is expected to increase by 500K. So this is the change in working capital. So it's good. Cost of equity is estimated as this. Number of shares outstanding is 1 million. Calculate the dividends per share, the free cash flow for the firm, the free cash flow for equity per share, and the residual income. Okay. So let's do dividends per share first. There are a few methods. Okay, for the first, dividends per share. Now, we get the earnings per share. So where do we find the earnings per share? So we calculate earnings per share. Let me just highlight this in this color. Our earnings is this, right? Net profit. And we know that we have 1 million shares outstanding. So we can find the earnings per share as given here. And then we know that there's a 60% dividend payout policy. So, we take this earnings per share, multiply by 60%. This gives us our dividends per share of 3.12. Alternatively, we can base our understanding of the clean surplus relationship to determine the dividend. So the clean surplus relationship simply uses the balance sheet figure. So let me flip back to the balance sheet. So where is our balance sheet clean surplus? So we need to have the this one, right? Book value of equity and again our net income here. Right? So we add up our book value of equity uh, of last year minus book value of equity this year plus any net income, and this gives us our dividends of this. Then divide by 1 million, we get the dividends per share. The second part of our question. So this slide again, if you downloaded the slide yesterday or today, it's fine. This has been I have added in a small little comment here, but if you have downloaded the slide last time, way back, you might not have this small comment. But I will explain the comment in a short while. All right. So for FCFA, recall that our formula has three components: the OCF, operating cash flow, NCS, which is your capital spent, and your change in net working capital. So for your OCF, I use the EBIT formulation. So EBIT formulation, basically I plug in the figures, your tax rate, and your depreciation. So I'm just going to flip back to show you. So I'm going to start off with EBIT. There's a depreciation here, tax rate of 20%, this one. So I'm plugging in the values to give you your OCF here. Then your NCS. So NCS, I'm going to show you two methods. First is your net FA method. Net FA, so it's given by this, right? I use all your net figures. So I'm just going to flip back to quickly show you where to get the value. So your net FA is here. And then you must add back your depreciation, which is here, right? So it's here. Or you can use your gross FA, so you do not include depreciation at all. Last but not least, I calculate my net change in working capital. So at this point, what we mentioned when we talk about net change in net working capital is that the idea of CA minus CL purely is a very accounting concept, right? I mentioned that in finance, we like to use different methods here and there. So that's the comment here that I've made. So in accounting textbook, change in net working capital is CA minus CL. This is true. But in finance, it's more practical, right? So sometimes we exclude cash and short-term investments in our CA. And on our CL, we exclude interest-bearing loans and bonds. So in this example here, this formulation here, you'll notice what? Okay, I'm just going to flip back to show you that our cash is not included. And I think marketable securities are also not included. Let me just double check. Marketable securities. Yes, they're not included. So this is our CA. CA. So our CA consists of the changes in the CA, right? Which is given by this chunk of things here. Inventory, receivables, and other current assets. Then what about our CL? So let's look at our CL here. Now let's go to CL. So this is our CL. So our CL is given by what? Our CL is given by this one. Sorry. And this one here, right? Basically exclude your short-term debt because your short-term debt is interest bearing, right? So in our net change in net working capital, think about it again, right? What's the purpose of net working capital? Is the capital is being spent on daily operations, right? So our interest-bearing loans typically are not really for daily operations. Yes, there might be specific like working capital loans possible. Now, but it is just a current portion of a long-term loan. Now, this current portion of long-term loan is not for working capital purpose, right? Which is why it's excluded. So in this sense, your this change in net working capital can actually be quite flexible. Yes, correct. So your current portion of long-term loans are generally relating to your capex. That's true. That's why it's not in your net working capital. So once you have determined, the this, this, and this, we can get our FCFF. So FCFF, since it's the free cash flow to the firm, we cannot determine the free cash flow to the firm per share. We can't do that. Okay. And then for your FCFE, now this is a bit more simple already. Once we have our, we can use the derivation of the net income plus depreciation plus net borrowings, then minus your these two. This one we have determined your FCFF, so not too much of an issue. The only thing that we determine now is our net borrowings. And we recall we can for net borrowings, we can just use the change in short-term loan plus the change in long-term loan. So I'm just going to flip back to just quickly show you where we pick the figures. So long-term debt here and our short-term debt here. So once we determine net borrowings, we simply, just add them all up together and we get this. Yeah, it's not for operations. That's right. They are referring to the why cash is not part of working capital. Oh, so but why cash is not part of working capital? Okay, so it's part of so it's right, it's not part of operations in the sense that yes, okay, cash might be used for operations, but sometimes the amount of cash that is being kept in the bank or not bank, sorry, in the company is based on strategic reasons. It's about cash management rather than operations. So right, when you think about operations, it's more about receivables, it's about payables, right? So the cash that you set aside in your company is more about the cash management policy. Sometimes you want to have more cash because you want to hit a target ratio, or increasingly, actually, a lot of the time, cash is being restricted. So we have things like restricted cash, where this cash being pledged for certain kind of financing, right? And then so the reason why you have a lot of cash, maybe is these cash are being restricted cash as being pledged for certain things, and so it's not really relating to operations, right? So it depends. Yeah, okay. Okay, so that's a good question. So for free cash flow, right? So remember again, right? The free cash flow that you have calculated, right, in what you have talked about in finance is very different from your cash in bank. Because that's a accounting thing, right? Your cash in bank is accounting. Now, what we are calculating for free cash flow model is what is the cash flow generated from the assets, and now in a sense for FCFE is the cash flow generated from the assets to your equity. The FCFF is your cash flow generated by assets to your debt and equity. So yes, there are different things. Okay. Last but not least, we have your residual income. So this one is not too difficult because the question has given you your cost of equity and book value of equity. Just want to take note is this T minus one, and your net income is this, right? So I'm just going to flip back to show you the figures of your T minus one equity, which is this one here, right? This one here. Okay, your 18K. Residual income, right? So that's all I have. We actually finished right on time. Uh, I know it's quite a bit to go through in this lecture. Lecture two, if unfortunately this module has quite a lot of information, maybe you might have more questions once you do a revision of what we have went through. But I'd like to pause here, also pause the recording. And do you have any questions?